Welcome back to More Money Minutes for Doctors, where we're going to be talking about I bonds and E bonds. Catherine Vestnes here. I am the founder and CEO of MD Financial Advisors, and we work with over 500 doctors. I used to say from Hawaii to Cape Cod, but we now have a doctor in New Zealand. So today we're going to be talking about markets, inflation, and how to protect yourselves. Because in this current market, many of our doctors are wondering how can they protect their money. And while we still stand by our belief very firmly that down markets is a great time to invest, we're also going to be talking about some lower risk options today. And hopefully these will offer some of our doctors peace of mind. Now, if you've got further questions or if there's something you'd like us to talk about in a future episode, please reach out to us at info@mdfinancialadvisors.com. And don't forget to like, subscribe, and follow us on social media at MD Financial Advisors. And that way you'll never miss an episode. All right, so we're often asked about bonds, certificates of deposits, and other types of fixed interest, lower risk options. Today, we're going to specifically focus on U.S. Treasury bonds, as these are the same for every doctor across the country. And we're going to take a look at I bonds versus EE bonds. So first of all, you may be wondering, what is a bond? A Treasury bond is a bond issued by the U.S. government, or in other words, the taxpayers are loaning the U.S. government money to help finance the government. Given how high our current debt is, you can imagine they need to be selling a lot of these bonds. Now, they are considered the safest of all possible investments worldwide. And many of our doctors are familiar with EE bonds, or at least the concept behind a EE bond. With a EE bond, you can purchase this bond at a fixed rate, and it continues to collect interest until you cash it in. And these interest rates are pretty low, but once again, the risk is considered to be some of the safest possible investments you could ever invest in. The current interest rate for EE bonds is a whopping 0.1%, or another way to think about it is 1/10 of 1%. So as I mentioned before, the current interest rate is 0.1. However, a very important thing to know about EE bonds is no matter what the interest rate is, they guarantee that they will double if you hold them for 20 years. So keep that in mind. A EE bond, if you bought it for $10,000 in 20 years, it's going to be guaranteed to be worth $20,000 no matter what the interest rate is. Now, what is becoming a bigger and bigger topic, and I hear about this more and more, are I bonds. These are U.S. Treasury issued bonds that are meant to protect your investment from inflation. Now, like EE bonds, I bonds do have a fixed interest rate, but they also have a variable rate, and this variable rate is calculated twice a year, and it's based on the Consumer Price Index. Now, these two rates are combined to create this compound rate for an I bond. Now, the current compound rate for an I bond, take a deep breath, is a whopping 9.62%. But that's partly because this is the highest inflation we've seen in at least the last 40 some odd years. Although I was reading something this morning that said this may be the highest inflation on certain items in 75 years. So very helpful to have something that could protect against inflation. Obviously a lot higher than the guaranteed rate on a EE bond of 0.1%. But let's compare and contrast EE bonds with I bonds, and you can get a better idea of whether this might be something for you to consider. Okay, when it comes to taxes, both EE bonds and I bonds are exempt from state income taxes, but they are subject to federal taxes. So one thing to consider is if you're a doctor in Washington State, Texas, Alaska, Florida, one of these other states that doesn't have a state income tax, then these might be slightly less attractive to you. Not the only consideration, but something to ponder if you decide these are worth it for you. They both have a minimum purchase electronically of $25, and they both have a maximum purchase. So with EE bonds, you can buy $10,000 per year electronically. The same for I bonds. However, with I bonds, if you get a tax refund, you can use your tax refund to purchase an additional $5,000. So technically, if you, assuming you were getting a refund, you could do up to $15,000 a year per person on an I bond. Now, both of these bonds earn interest for 30 years unless you cash them in earlier. Now, here's one other catch. In either case, you cannot cash these in the first year. So that's extremely important. The government needs to be able to rely on your money to pay its bills for at least a year. So you definitely do not want to invest in these if you think you're going to need the money within the first year. If you cash them out in years 2 to 5, you lose the previous 3 months interest. This is the government's way of trying to make sure you hold on to these as long as possible so they can hold on to your money as long as possible. And they do that by penalizing you if you walk out earlier. By the way, if you cash your bond after 24 months, you get the first 21 months of interest, just as a way of example. After year 5, there's no penalty for cashing in either of the bonds early. Now, for both, the interest is earned every month and is compounded twice a year. It's considered to be part of the principal, so it helps compound. Now, in conclusion, as you're thinking about, is this something that's appropriate for you? This is not a good choice for clients who might have to tap into the funds, particularly in the first year. So if that's your situation, I would not encourage you to do this. Secondly, these bonds, we can't help you purchase them. They can only be purchased through the U.S. Treasury online, so you would have to do that yourself. And I think they could be a good choice for clients who want to use funds to fund their college for their children, because the I-bonds, you can use the interest earned on these I-bonds without having to pay tax if it's used for certain higher education expenses. So once again, it can be a good choice for part of your college funding budget. But overall, these bonds are a low-risk way to continue to have your money work for you. Usually low risk means low reward, but in today's market with the CPI inflation records setting are so high, these I-bonds might be something worth considering. So reach out to your financial advisor if you'd like to find out whether they might be a good choice for you and how to go about getting them into your portfolio. So in closing, I hope you'll follow us on social media. As you know, I have a complete passion for helping doctors have a sense of security about your life. I don't want you to face what I faced in my life when my parents, my mother was a certified registered nurse anesthetist, and my stepfather was a bariatrician. When they got into financial trouble, their lives became very, very difficult. I don't want that to happen to any of our listeners or to any of our clients. So if we can help you at all, please let us know. And in the future, I'd love to answer your questions, or if you've got any topics that you'd like us to cover, you can send those to us. And finally, if you'd like a second opinion on your financial health, you can reach out to us by emailing us at info@mdfinancialadvisors.com. So in the meantime, please stay healthy, take care of yourself, and prosper.